Have your investment strategies been working for you as you'd hoped? If your answer is anything less than a resounding yes, then you're in the right place. Today, we're going to introduce you to a book that has stood the test of time, a classic that has guided countless investors towards financial success, The Intelligent Investor by Benjamin Graham. This book is not just about investing, it's about making informed investment decisions. It's about understanding the true value of an investment and how to analyze companies before taking the plunge. Graham's book emphasizes the importance of fundamental analysis and offers strategies to avoid excessive risks, ensuring stability in your investments. So whether you're a seasoned investor or just starting out, this book holds the keys to understanding the fundamental principles of investing. It's a valuable resource that could potentially change your financial future. In the following scenes, we will delve into the key concepts of this classic investment guide. So what exactly is investment value? Well, it's a critical concept to grasp if you're looking to make informed investment decisions. Investment value is the intrinsic or true value of an asset or a company. It's what the asset is really worth, independent of its current market price. It's like knowing the real worth of a diamond, even if it's currently being sold for less. This concept is key for long-term investing. Why? Because it allows you to identify and invest in assets that are undervalued by the market. Think of it like this. You're at a yard sale and you spot a vintage, mint-condition comic book. You know that this comic book is worth a lot more than the seller is asking for it. That's investment value. Understanding investment value is the first step toward making informed decisions. When you know the true value of an asset, you can compare it with its current market price. If the intrinsic value is higher than the market price, the asset is undervalued. This could be a great investment opportunity. On the other hand, if the market price is higher than the intrinsic value, the asset is overvalued. It might be wise to steer clear or sell if you already own it. It's important to stress that determining investment value isn't always straightforward. It requires a deep understanding of the company and its financials. It involves studying balance sheets, income statements, and cash flow statements. It also involves predicting future earnings and cash flows. But don't worry, it's not as daunting as it sounds. With practice, you'll get the hang of it. Remember, the goal of investing isn't just to make money, it's to make informed decisions that can lead to consistent, long-term returns. And understanding investment value is a big part of that. Remember, investment value is a crucial factor in determining your long-term returns. So, take the time to understand it. It might just be the key to unlocking your financial success. Have you ever wondered how successful investors pick their stocks? It's not a game of chance or a blind leap of faith, but a methodical, systematic analysis of the fundamentals. This is the crux of Benjamin Graham's investment philosophy, a deep dive into the numbers, the facts, and the figures that define a company. Fundamental analysis is the process of examining a company's financial health, market position, and competitive edge. It's like peeling back the layers of an onion to reveal the core of the business. It includes studying financial statements, industry trends, and even the company's leadership. All of this information is used to determine the intrinsic value of the company's stock. Now, why is this so important? Well, imagine buying a house without checking the foundation, or purchasing a car without looking under the hood. You wouldn't, would you? The same principle applies to investing. Without a thorough understanding of a company's fundamentals, you are essentially investing blind. By conducting a fundamental analysis, investors can identify companies that are undervalued by the market. These are the hidden gems that offer the potential for substantial long-term returns. Not only that, but it can also help investors avoid companies that are overpriced or facing potential financial difficulties. Benjamin Graham, the father of value investing, believed that the market often misprices stocks, creating opportunities for savvy investors. By focusing on the fundamentals, investors can capitalize on these market inefficiencies and build a robust and profitable investment portfolio. But remember, while fundamental analysis can provide valuable insights, it is not foolproof. It's just one tool in the investor's toolkit. It should be used in conjunction with other methods and strategies to make informed and balanced investment decisions. So, The next time you're considering an investment, take a leaf out of Benjamin Graham's book. Don't just follow the trends or rely on your gut instinct. Dig deep, do your homework, and understand the fundamentals. Remember, without a thorough fundamental analysis, you're just gambling, not investing. No one wants to lose money. So, how can you avoid excessive risks in investing? Well, according to Benjamin Graham's Book of Smart Investing, the first step is understanding the concept of risk itself. Risk in the context of investing isn't just about the possibility of losing money. It's also about the unpredictability of returns. One of the key strategies for risk avoidance that Graham advances is diversification. By spreading investments across a range of different assets, you can cushion against potential losses. If one investment performs poorly, others might do well, offsetting the loss. It's a bit like not putting all your eggs in one basket. Next, Graham emphasizes the importance of a safety margin. This is the difference between the price you pay for an investment and its intrinsic value. By purchasing investments for less than their intrinsic value, you create a safety net. This margin of safety can protect against losses if the market doesn't behave as expected. Another strategy is to focus on long-term investments. Short-term market fluctuations can be unpredictable and risky. But over the long term, good investments tend to yield positive returns. So by taking a long-term view, you can reduce the risk of being caught out by short-term volatility. Graham also advises against speculative investing. Speculation involves buying an investment with the hope that its price will go up without any real analysis of its value. This can be risky because it's based more on hope than on solid financial analysis. Lastly, Graham underlines the importance of regularly reviewing and rebalancing your investment portfolio. This allows you to adjust your investments in line with your risk tolerance and investment goals. So, there you have it. Diversification, safety margin, long-term focus, avoiding speculation, and regular portfolio review. These are some of the key strategies that Graham suggests for avoiding excessive risk and maintaining the stability of your investments. Successful investing isn't about avoiding risks entirely, but managing them effectively. And with these strategies in hand, you're well on your way to doing just that. Investing isn't just about making money. It's also about making ethical decisions. Benjamin Graham, in his significant work, underlines the importance of ethics in investing, which often gets overshadowed by the lure of quick profits. He brings to light how ethical investing isn't just a moral choice, but it can also contribute to overall financial success. Let's delve into this further. Ethical investing, often referred to as socially responsible investing, means aligning your investment choices with your moral or ethical beliefs. It's about investing in companies that are making a positive impact on society and the environment. This could range from companies that are championing renewable energy to those that are committed to fair trade and labor practices. Now, you might wonder, why should I bother about ethics while investing? Here's why. Companies that prioritize ethical practices tend to be more sustainable in the long run. They are more likely to have loyal customers, motivated employees, and they are less likely to face legal or regulatory issues. These factors can all contribute to the company's long-term profitability and stability, which, as an investor, is exactly what you're looking for. But there's a catch. Ethical investing requires doing your homework. You need to dig deep into a company's practices and policies. You can't simply rely on the company's claims about being green or ethical. This is where Graham's emphasis on fundamental analysis comes in. It's not just about looking at a company's financials, but also understanding its operations, its impact on society, and its future potential. In conclusion, ethical investing aligns your financial goals with your personal values. It allows you to contribute positively to society while also positioning you for financial success. So the next time you're about to make an investment decision, remember to consider the ethical aspect of your choices. Remember, ethical investing isn't just good for society, it's good for your portfolio too. Let's recap what we've learned today. We've delved into the heart of smart investing, exploring the importance of understanding investment value. This is a key concept that can lead to substantial long-term returns if properly harnessed. We've also underscored the significance of fundamental analysis. It's not just about the numbers, It's about deeply understanding the companies we invest in and their potential for growth and success. Moreover, we've discussed strategies for risk avoidance. Remember, investing isn't about taking unnecessary gambles. It's about calculated risks and maintaining stability. And let's not forget ethical considerations in investing. Making money doesn't mean we can ignore the broader implications of our investment choices. By applying these principles from The Intelligent Investor, you can make more informed investment decisions and achieve financial success. Remember, investing isn't a race, but a marathon. With the right knowledge and strategies, you can cross the finish line with flying colors. Until next time, invest wisely and prosper.